Hey everybody, welcome back to the channel. So I recently saw an article in one of the newspapers where an investigation just happened around a flash crash where a trader made a big mistake. Essentially, they have now called a fat fingers mistake where they put an extra zero on the end of the size of the trade and it caused a crash in the Swedish markets, which had a ripple effect onto other European markets and at one point wiped 300 billion euros off stocks across Europe. Now that got me thinking how easy that is to do. Now, I've been guilty of that mistake many times in the past and I still do it today, which again is a bit unfortunate and I should learn from that. But again, it's so easily done, especially when using MetaTrader and we're actually going between different contract sizes and lot sizes. For example, if I'm trading the FTSE 100, then I'm trading at typically 20 lots on my broker platform, which is £20 per point. If I then switch over to gold, and because MetaTrader generally remembers the last trade I did in lot size, and I trade 20 lots on gold, that's significantly more than I ever would trade. Typically I'm only ever trading 2 lots on gold. So you can see very easily how just switching between the charts and broker platforms, we can make some very simple mistakes. Now, when this happened in the bank, that shouldn't have happened. And essentially it's come back to a broker working from home. And if normally in their office, you'd have risk management teams or other layers of mitigation who would check the trades going in to make sure this mistake wouldn't happen. And it's actually quite interesting that although the stock markets crashed by close to 8%, although it did recover later the next hour, the bank in question were actually looking to make a loss of $50 million. Now, that's strange to me because if you're shorting the market and it crashes that quickly, then you're assuming you're making a massive profit. Now, I think they're actually going to have those profits struck off because obviously it caused a massive crash across the European markets and regulatory things will come in and say, okay, fine, you can't make those profits, and they might still be fined because they're causing that. Now, at the time, they didn't know what had caused the crash. They thought it could have been a lot of algorithmic trades going on just in the markets. But it turned out there was a trader in London. The markets there were closed, but it was obviously trading on European stock markets. And because of the low liquidity in the markets and low volume, this one caused a massive spike and caused a crash. It just goes to show that although we believe that there's lots of manipulation going on, it can just be down to simple errors that are causing this crash in the markets. And obviously as traders and home retail traders, we just need to be very, very careful. If we do make those mistakes, what are we going to do? Now, recently when I have made those mistakes, again, I try not to, but we're all human, we do it occasionally. My first way I noticed that is because actually the trade goes into a massive loss because you've obviously got the spread and the trade size is significantly bigger. You're going to see a much bigger loss to start off on the actual account. Now, a lot of times you can hold that for a very small pip movement and close out for a break even or a small profit. Some people might just let that run and just risk it. But for me, when you're going in 10 times bigger than the actual position you should do, I would rather just take the loss straight away, even though it's going to be it's not massive, it's only going to be a fraction of a percent on the scale of the actual account size, but what it could become is significantly worse. You imagine you were going to short the markets 10 times bigger than you're actually looking to do. It only has to go a very small margin against you, and you could very, very quickly get 1, 2, 3% into drawdown very quickly. And if we were obviously risking 1% of our account and we were looking to have our stop loss there, because we are trade size 10 times bigger, we're actually risking 10%. Now, if you're on any prop firm challenge, that would actually break your daily drawdown as well as your max drawdown if that was to go against you very quickly. So for me, when I make those mistakes, and they're becoming a lot fewer now, I will just close the position out as soon as I can and take the loss. And I think that's what a lot of people do rather than trying to hold on. Now, if you do hold on to the position and it does go your way and you make a massive profit, for me, that's not a profit well earned. It's just basically comes into the gambling equation. We take a too big a risk, too big a position size, and it wasn't well calculated. And for me, those profits aren't well earned. So yeah, I don't like taking profits on those things. So that's just my personal way of trading. And I'm sure a lot of people out there do exactly the same thing. So yeah, just so one of those common mistakes we all do, and just be careful if you are working between different MetaTraders or different brokers who have different lot sizes between their actual instruments. Just be careful because mistakes can happen. It's not just us retail traders, it is the pros and the banks making these mistakes. And it probably happens a lot more than we actually realise. This one obviously caused a flash crash because of low liquidity. If it was on a normal day, this may not have even happened. It might have just been a normal trading day and they could have got out of it without even noticing it. But yeah, I hope you enjoyed today's quick video. It's been a bit insightful to see what goes on in the markets with other traders, and I'll catch you again soon. Cheers!